And two, if they were a normal commercial bank, they would be on the verge of bankruptcy. So they're months away from having negative tangible equity. The challenge now is that here in the 2020s, some of those things that those people that were concerned about in the late 80s and the early 90s are actually starting to manifest just way later than they thought. I think deficits are actually going to be a problem in developed countries, really for the first time since the 1940s.
This is the 11th time that you're on our show, and this is episode 533. I mean, can you believe it? So I don't want to do the numbers, but I don't know, 2% ish sounds about right. That's be you on the show. So I hope we can increase that percentage as we go along. It's always a lot of fun whenever you're here.
I really appreciate that. Big fan of your show and multiple of the different shows your network does. I think that's one of the best parts about it is like the broad set of perspectives.
Well, thank you for saying so, Lyn. And let's just jump right into it. Today, I would like to talk about how the Fed went broke. But before we do, and perhaps to sort of like create a foundation for everyone, perhaps we can zoom out. And if I can ask you to explain what is on the assets and liability side on the Fed balance sheet, then perhaps we can talk about how that is similar to how a commercial bank running their balance sheet.
Sure. And so basically, in a lot of regards, the Fed is very similar to a commercial bank. I mean, there are very important exceptions where it's not, but in terms of the over like arching details, it's actually pretty similar. So if we look at a commercial bank for a second, they have assets and liabilities. The assets exceed the liabilities. That's an important part of their solvency, and their assets generally pay higher interest rates than their liabilities. Kind of the purpose of a bank is to borrow money at cheap rates and lend money with a little bit more risk and a little bit more duration at higher rates, as well as collecting fees and things like that along the way. And so for a typical bank, their liabilities are mainly their deposits. So basically, when you deposit money in a bank, that's your asset, it's their liability, and interest rates they're generally pretty low. On the bank asset side, depending on the type of bank it is, they do mortgages, they do business loans, they do credit card lending, they do all sorts of different types of lending. And those are ones that are generally a little bit riskier, higher duration, but they pay higher interest rates. And so they can absorb some, small percentage of defaults, build positive capital, pay dividends, fund their operations, and maintain positive equity and positive capital. Um, when you look at a central bank, it's very similar, but there's a couple different categories for their assets and liabilities. So their liabilities are one, banknotes, right? So physical cash in circulation is a liability of that country's central bank, and those are obviously 0% yielding assets, right? If you hold a dollar bill or a physical euro, you're not getting paid interest on this. So that's obviously already a good start for them, right? They have 0% liabilities there. But they have other liabilities that, for example, consist of bank reserves. So much like how we deposit money at a bank and that's our asset and their liability, banks have to deposit their cash, their spare cash, at the central bank, and that's an asset for the bank and it's a liability for the central bank. And just like how a bank pays interest, a central bank also in many environments does pay interest on those reserves. And the reason they do that is because it's an important part of how they manage their short-term interest rates. It basically presents a floor, right? If you can put reserves in the central bank, and get say 5% interest on it, there's no reason why you would lend to anyone else at below 5%, because you're just taking on more risk and for less return, right? And so that's one of their important policy tools. And then there are other liabilities they can do, like reverse repos and things like that. They get more complex, and some of those do pay interest. So that's the central bank's liability side. On the asset side, it actually looks pretty similar to a commercial bank. They have things like treasuries, the government debt of whatever country they operate in. So those pay interest. They also often have mortgage-backed securities, right? So they have mortgage exposure. Obviously, these details would differ around the world, but for example, the Federal Reserve has a lot of mortgage-backed securities. These also pay interest. And then in some countries, they'll have things like corporate debt, or they'll have things like equities. Those are generally considered less traditional types of assets for central banks to hold, but you see some like Japan kind of going that route, and sometimes like the Fed and others will do that temporarily during crisis. things like corporate debt. Um, and in most contexts, the Federal Reserve's assets are bigger than their liabilities, and they pay a higher rate than their liabilities. And it will then differ from jurisdictions, but usually the central banks operate like utility, where it has to pay its excess profits back to the government. It doesn't just keep building capital like a commercial bank would. Although in some jurisdictions, they actually you can publicly hold shares of a central bank, and they will, they could pay dividends, they could do things like that. But if you look at the Federal Reserve, so it's not publicly held, but it is held by banks. They basically pay a small dividend to their owners, they pay their operating expenses, and then they have to send the rest of their profits back to the Treasury, right? And so it's actually a source of income for the Treasury. And it kind of makes it so that any sort of treasuries held by the Fed are effectively interest free because they are paying interest on them, but a lot of these profits are just getting sent right back to the Treasury. Um, the challenge in recent months, really ever since September, is that the Federal Reserve increased interest rates so quickly and so significantly. And for the first time, they got above the prior cycle's high in terms of interest rates, or at least the first time in decades. We've had this kind of declining trend of lower highs in terms of interest rates, but they actually got way above that. And so their liabilities pay higher interest rates than their assets. And so obviously their banknotes are still paying zero, but their other areas, their bank reserves and their reverse repos in the Fed's case, are paying a higher interest rate than their treasuries and their mortgage-backed securities that in many cases are longer duration, they're fixed rate, they're not adjusting upwards. They hold them from years ago. And so they have a mismatch. And so one is they're no longer profitable. They're not sending um, any more remittances to the Treasury. Um, and two, if they were a normal commercial bank, they would be on the verge of bankruptcy. So they're months away from having negative tangible equity, which is any normal bank would be bankrupt. But because of the central bank, they get that's where they have a very, very big difference. They basically get to just put a placeholder there that kind of is like an IOU, and so in the future, if they're ever profitable again, then before sending more money to the treasury, they get to pay themselves back. So basically, they're losing money. They're going in towards negative tangible equity, but they're filling that negative equity gap with IOUs on their future income, which of course for any private entity would be red flags all over the place, absolute catastrophe. You wouldn't touch it with a 10-foot pole, but it's different if you're the central bank. But even though it's different, it does have some important ramifications. I've been talking for a while, so I'll stop. But that's essentially the high level overview of what happened here.
And then I really like that you talked about this. And I think a lot of people are they're not even thinking in the first place about Fed being profitable or not. That's probably not how they see the Fed in the first place. But from January 2011 until December 2022, the Fed paid approximately $1 trillion in cumulative remittances to the U.S. Treasury. And these are the payments you referred to before. They're not flowing anymore. Now, the listener might be concerned, or perhaps the listener is not concerned at all. They might say, why is that a big deal? Can't the US Treasury not just borrow the difference? Like, we hear all about this, all the debt. Why not a bit more debt?
Yeah, it's a good set of questions, and there's a couple avenues to approach it on. One, we can talk about why a central bank should be profitable, and then we can go into the second question. So the main reason you want a central bank to be profitable is that you want them to be independent, or at least as independent as they can be. The worst case scenario is to have a central bank that's completely beholden to like the central government of that country. Because if that's the case, they can do things like, call the central bank head and tell him to cut interest rates 6 weeks before a election, for example, right? You can get very, very manipulative very quickly if the government actually controls the central bank, controls the price of money for the entire economy, can do all sorts of things like that. And so for that reason, most central banks are designed to be somewhat independent, in the sense that they're not completely independent, but they're governed by laws, and their leaders are often appointed by the country's Congress, Parliament, leaders in various ways, but with terms that are pretty long and that are hard to dismiss. So the president can't just call them up and tell them to do something. And part of what maintains some degree of credible independence is that the central bank is not like financed by the government. right? Because you can, if you have independent terms and things like that, but the government can just shut off your funding if unless you do something, then you're not independent, right? And independence is a limited concept in the sense that it goes away during war, pretty much. It goes away during absolute crises. But on a normal operating basis, election cycles, things like that, it is supposed to be pretty independent. And so maintaining positive equity, maintaining some degree of profitability is important for a central bank's independence. If they have deeply negative equity, if they're operating on massive losses, um, that becomes a problem. And so that's one where it's relevant when you start to see a central bank with negative tangible equity and kind of no um, path towards profitability in the foreseeable future. Um, that that's a challenge. Number two is that in this world of rising deficits, um, some of these things that we're kind of desensitized to, right? So, for example, the U.S. Treasury just lost $100 billion revenue source per year from the Fed. And we're like, well, I mean, we're talking about trillions now. Who cares about 100 billions? But for context, that's about 4 times the size of NASA's budget, right? If you heard that, the government's going to 4 times the size of NASA's budget, there are a lot of people that be like, oh no, we can't. We're just going to keep spending now. We're just going to keep, doing this. Whereas on the other side, we just lost a revenue source that's 4 times NASA's budget. So that's 100 billion more treasury debt that has to be issued each year, all else being equal. So that's number one. And number two is the fact that for the past 40 years, we've had in many developed countries rising debt to GDPs at the public level, but it's been offset by declining interest rates. And so the interest servicing costs, especially as a percentage of GDP, has not been rising. In many cases, it's been falling or flat. And the problem that we now face is that we hit zero or even slightly negative in many countries. Now we kind of bounced off zero. Now we're kind of sideways to up while deficits are still being accrued, debt is still being accumulated. And so we're paying higher interest on higher debt. And that's where you risk a fiscal spiral. I think that, I mean, a good analogy is the European sovereign debt crisis when you had just basically, you know, people no longer trusted the fiscal solvency of many Southern European countries. Their interest rates exploded, and if unaddressed, that would just spiral into a fiscal default essentially. And so that can also happen in other countries, with the difference being that they have more levers they can pull internally to finance their own government deficits.
Yeah, Lynn, there are a lot to unpack there. I really like what you said about uh, the independence. I hear a lot of people talking about how uh, central bankers should be elected, like in any good democracy. And I don't know if it's because I'm sitting in the echo chamber that I'm hearing that. I don't know if that's always been the case. But and I think that we have this idea that democracy is good, and if it's not a democracy, it's bad. And I don't want to be quoted on that because I also think democracy is good. But there are just some things that's probably not good if it's purely democratic, like the Fed. Like so imagine that uh, you had there had two different candidates to be Fed chair, and one saying we should hike interest rate, and one said the opposite. And it was the population who had to elect the new chair. Who would the population elect? Like I just that in itself is just an interesting thought. And I can't help but like make the comparison to the question about if you ask people, do you want to be a millionaire? Um, Everyone would say yes. But if you ask them like why do you want to be a millionaire, they're gonna say things like, "Oh, I'm gonna buy a new car, a bigger house, a boat," which is ironically the very opposite of being a millionaire. And I kind of feel like the idea of not having, um, uh, the idea of having a democratic elected central bank might give you the opposite of what you want. As much as we can bash the central bank in its current form, that's not what I'm trying to say at all. So anyway, I just wanted to bring that point of view into the debate here.
Yeah, one of the interesting, basically, if you had elected central bankers, especially on kind of the same term cycle as other political leaders, you generally have a lot of agreement between the central banker and the government. And so you probably would give the government more control over the price of money and generally financing. In the United States, for example, we have the Supreme Court. They're not elected, but they're appointed by the people we do elect, and they have well, they have indefinite terms, which is kind of a debate in its own sake. But either way, their terms are much longer than other ones. And generally, you don't want to see outright political comments from a Supreme Court justice, even though the court at the times does become very politicized. And it's kind of the same thing with central bank. Like you expect political comments out of your president, you expect political comments out of your your Congress, your parliament. But generally, in a lot of countries, you kind of the society and the government is structured around where you don't really want to hear political comments out of your Supreme Court justices or your central bankers. They're kind of meant to be a different type of political leader in a way, even though they still are political leaders. And so, in some ways, it's like an illusion, but it is somewhat of an important illusion, and it does have some tangible, effects. I mean, right now, for example, Jerome Powell. I mean, last I checked, he's registered Republican, for example, under a Democratic president. Uh, but even when Trump was in charge, Trump was criticizing Powell for raising rates, and because we do have some degree of independence. I mean, Powell is basically not subservient to any president. He can't just be fired. He's not part of the executive branch, and that is important. And he can't have his, it's harder to have his funding source pulled if the central bank is a profitable institution. And in order, the government can override the central bank. They can change the laws that they operate with, but in a divided government, that's hard to do, right? So the president can't do that unilaterally. It takes a pretty big consensus of government to do that, and so central bank independence is kind of a spectrum, right? In a what you would call quote unquote banana republic, it's generally when you see like massive deficits, people say, oh, that's banana republic stuff, and it's like, well, because you're generally talking about jurisdictions that don't have these strong institutions that are some degree of separate and kind of balancing each other out. Whereas in the United States and in a number of other developed countries, you at least have some degree of central bank independence, and but it does start to erode at times of crisis or war, which has also been a big theme of my macro research. That I do think, in general, this is an era of much closer interaction between the central bank and the Treasury because the central banks get overrided in many other ways. Basically, one of their mandates is financial stability, and sometimes the government can mess stuff up so bad that the central bank has to do things they prefer not to do in order to maintain, basically like avoid sovereign default or keep markets liquid, things like that. And if they become heavily politicized, and so this is, that's why I keep comparing the 2020s to the 1940s, which is not a great analogy, and I hope that obviously certain things are very, very different than 1940s, but in a lot of macroeconomic ways, it actually is kind of similar.
Very much so. And we talked about this. I want to say it was the last episode we had. I'll make sure to link to that in the show notes. It's a very interesting observation that you made in comparing today with the 1940s. Unfortunately, um, I want to talk to you about your wonderful blog post, how the Fed went broke. And in that blog post, you state, by the end of this decade, I have considerable concerns regarding a financial spiral occurring in the United States and other developed countries, meaning that a combination of high deficits, high debt, and high interest rates on those debts will all work together to create structural inflation and money supply growth. Now, lot to unpack with that statement. But first, perhaps, Len, if you could paint some color around what do you mean by structural inflation and money supply growth, and then perhaps we can sort of like unfold based on that.
Yeah, so basically, money supply growth is heavily correlated with inflation, especially on a persistent basis, not like a year-over-year basis, but on say rolling 5-year periods. Money supply growth and price inflation are pretty heavily correlated, and money supply growth can come from one of two main avenues. One is bank lending, right? So as banks lend more, they increase the money multiplier. They lend more deposits into existence. That's one form of money creation, and the other one is very large fiscal deficits, especially when they're monetized by either the central bank or the commercial banking system. Um, and those are the two avenues for how a lot of money can be created. So, for example, the 1910s, 1940s, and recently, due to the whole pandemic stimulus, those periods of rapid money creation were mainly fiscally driven money creation. Whereas the 1970s that everyone thinks of when they hear about inflation, that was in many cases there was fiscal deficits, but they were smaller, and instead you had peak bank lending. And a lot of that was because you had peak demographics, right? So the baby boomer generation was entering their home buying years, their peak consumption years for like a 20-year period. And that was a very big environment for bank lending, especially in developed countries. And so that's kind of the two avenues when thinking about. And during the 80s, in order to try to quell that bank lending, Paul Volcker raised interest rates super high, and then basically those rates stayed pretty high even after him for quite a while, and he started to get much higher debt to GDP. Right? So from the 1940s to the 1970s in the United States and many other countries, you had declining debt to GDP. A lot of that was financial repression, so interest rates were below the prevailing inflation rate about half the time. And so you basically you had nominal GDP kind of catch up to the debt in many cases. But either way, you had declining debt to GDP. But starting in the early 80s in the US and many other countries, you had rising debt to GDP, which became pretty structural. Um, and so by the end of the 80s, you had a lot of concerns around the debt and interest servicing. And so, for example, the famous like U.S. national debt clock in New York was installed in the late 1980s. And we had Ross Perot in the early 90s run as an independent political candidate, one of the most successful political independent political candidates in history. Like he actually had a meaningful percentage of the vote, which is normally just Republican or Democrat, and he ran on a platform of basically the debt's a problem, right? So that whole period was kind of a crescendo, and people getting very concerned about debts and interest on the debt. But the punchline is that they were way early. So basically, right after that kind of crescendo, you had a period of 1990s, so booming economy, uh, peak demographics in terms of workforce participation, right? So the United States had the highest ever labor participation by the late 90s, early 2000s. We actually had a brief budget surplus. You had declining interest rates. So even though debt to GDP was pretty high, you had falling interest servicing costs. And then, of course, you had the 2000s and then you had the 2010s, basically this big banking bust, disinflationary period, things like that. Um, the challenge now is that here in the 2020s, some of those things that those people that were concerned about in the late 80s and the early 90s are actually starting to manifest just way later than they thought because we had to get through that period of peak demographics. We had to get through that period of declining interest rates. And now you have a period of very large fiscal deficits, many countries above 100% debt to GDP, and interest rates that are no longer declining and don't really have anywhere to decline to below zero, for example, much below zero. And so they're kind of in a period where they're stuck. You have high debts, high deficits, and high interest on that. And a lot of that's tied to demographics and entitlement spending. So it's not like a war that can just go away suddenly. It's kind of projected out into the 30s. Like it's going to keep compounding. And so by the end of this decade, I think that's going to be a meaningful problem. I think the combination of I think deficits are actually going to be a problem in developed countries, really for the first time since the 1940s, and that this is going to be a macroeconomic trend to be aware of for investors, and it's also going to, I think, add to basically political polarization, turbulence, things like that, because in those types of environments, things like interest rates become politicized. Um, because you're kind of out of control there.
So could we try and dig a bit more into this? What you said there at the end, Lynn. So if things indeed unfold the way that you describe, which implications would it have for us as citizens? And then perhaps the second part of that question would be how what should we do as investors to position against what may or may not happen here?
Yeah, it's a good set of questions. So if you have inflation caused by bank lending, the correct answer for central banks is to raise rates, try to slow down that bank lending, harden the money, get the positive real rates, discourage kind of excessive bank lending. If you have um, inflation caused by rapid fiscal spending, then really it's pretty hard to get inflation down until you stop that excessive fiscal spending, which is what happens after a war is over, for example. But because this one's entitlement driven, it's really not ending anytime soon. It's very unlikely to be restructured in many countries. And so the implication is that you have very, very large structural fiscal deficits. And if you flip that around conceptually, Basically, the deficits of our government are a surplus for the private sector, which sounds good at first. In fact, many MMT advocates kind of refer to like that positively. But in inflationary terms, that's also true, right? So, for example, if they're running 10% of GDP deficits year after year after year, that's actually money creation. It's kind of pouring into the private sector, especially at times where the central bank is monetizing those fiscal deficits. And so you end up having above average money supply growth, not necessarily every year, but on a, say a rolling 5-year basis. And that is likely to transit into higher prices, especially if you have other things like, constraints on commodity supplies, basically, tight supply demand spreads among commodities and infrastructure and that sort of thing, as well as labor demographics. And so that ends up being a rather inflationary cycle, and it's one where, ironically, raising interest rates can exacerbate the inflation because it actually increases the deficits that governments are pouring into the private sector, right? So raising rates will squeeze the private sector, but if they're not the ones primarily causing the deficit and causing the money creation, then those higher rates can actually result in even more inflation. And so they are stuck in a rock between a hard place because if you raise rates too high uh, over a long enough time frame, you're exacerbating fiscal driven inflation and deficits. But then if they try to do financial repression, they go to low interest rates despite that. Then it encourages speculative attacks on the currency. Basically, everyone should borrow currency and buy harder assets with it, which creates more money and therefore exacerbates inflation. And so they try to stop that as well. And they often turn to capital controls and things like that. So from an investor perspective, um, there are going to be times like say, last year, perhaps parts of this year where you want to own safe paper assets, things like, T-bills, cash. But over the course of a decade, those are likely to lose purchasing power on a structural basis. And that instead you probably want to be in generally harder assets on average, things like commodities, infrastructure, certain types of value stocks. Basically, that's an environment where generally value stocks do outperform growth stocks more often than not. um, Gold, Bitcoin, um, potentially emerging markets. Countries that don't have those high debt problems, but that have other tailwinds associated with them, I think can do pretty well. And so you generally want to be in things that didn't do well in the 2010s decade, and that instead generally did better in say the 2000s decade. I think that's kind of environment you want to be at least maybe not all in on, but that your portfolio is kind of shifted towards if you think that thesis is correct.
Do you have any emerging markets that you would prefer compared to others?
I generally like India and Brazil for very different reasons, and they're not without risks. So I do, you have to position size these carefully. India has very strong demographics, very good structural growth. They still have low household debt relative to GDP compared to many other countries, so they're still actually underbanked, underfinancialized in many cases. So I'm pretty bullish structurally on India and just large Indian banks on say a 5-year basis. Um, Brazil is a instead so India is kinda like a growth story, whereas Brazil is more like a value story. So during periods of strong dollar and weak commodities, Brazil often enters depression-like conditions. So this happened in the '80s. It happened to some extent in the late '90s, and really ever since 2014, ever since we had the end of a period of QE, we had a kind of a stronger dollar. We had oil come off of its like $100 plus barrel period that it was in back then. Brazil's been in this kind of depression-like condition. But if we do get a very strong, um, kind of commodities decade, I do think that Brazil can do pretty well. They currently have positive real rates. They jacked interest rates up super high to try to get ahead of Fed tightening, and so they actually have positive real rates. And so their equities are very cheap. There's obviously political turbulence. There is tail risk associated with that. But I think as an appropriately sized position, I think that's another way to kind of play on the fact that the US is going to have these kind of out of control fiscal deficits for 5, 10, 15 years into the future, while Brazil's actually in a little bit better shape in that regard and might actually stand to benefit. And so there's select emerging markets like that that I like to combine with those other types of value stocks and commodities and kind of alternative monies, things like that.
Yeah, it's very interesting. You should mention that. Having a lot of US based friends, a lot of them, whenever they talk about diversification, they talk about, let's say, I have these properties in these 5 different states, and now I want to diversify, so now I'm buying the S&P 500, and saying, oh, that's US stocks, but we also have international exposure because by definition, a lot of these US stocks, like say Apple, they have more revenue abroad than domestically. Do you think that's a valid diversification strategy, or do you think it's still too US centric?
I think it's generally too US centric. I think I think having commodity exposure, even if you stick with US companies or just commodities in general, can balance some of that out. Because like during the past kind of 4 decade period, bonds were the kind of the main offset to equities. Where I think going forward in this type of environment, commodities could be somewhat of the offset. Basically, if commodities are going down, central banks are able to kind of get more dovish. That's generally good for equities. On the other hand, if commodities are soaring, central banks are likely to freak out, be more hawkish, and that can really quell equities. Not necessarily in any sort of given 3 month period, but I think that's a general trend to be aware of. That these higher input costs can really benefit certain sectors and hurt some of these other sectors. So I do think that commodities are a way to diversify somewhat without actually going into international markets. But I do think international markets can add another dimension of diversification. If you look at most metrics right now, there's so much global capital stuffed into US markets. We've really had a perfect storm to encourage that over the past decade. And so we kind of saw this in the late 90s as well, early 2000s, just like tons of global capital is all stuffed into US markets. And that can be a pretty painful unwind over, say, a 5, 10 year period if you get to that point. And so I do have concerns about, you could have a period where the S&P 500 goes sideways, especially in inflation adjusted terms. Same thing for many types of US real estate. You could go sideways for 5 years, 10 years in inflation adjusted terms, while certain sectors or certain foreign markets or certain kind of global assets outperform on like they outperform that kind of sideways price action.
Then I want to talk about a bit about money creation. We previously talked about money creation here together with you on the podcast and the role commercial bank system plays in that. We also, from time to time, hear this chatter about central bank digital currencies, not just in the U.S. but in Europe, China, other places too. Which, depending on how it's set up, of course, but the intention could be to replace the current process for money creation. I actually wanted to go into this topic from a slightly different angle, and I don't know if I could call it a more pragmatic approach. Do you think that the commercial bank lobby will ever allow the money creation process to happen outside of their system? Like, how can we think about that to arise, I guess?
So I think in countries with strong banking systems like the United States, you're unlikely to see them kind of shift their power towards the central bank and towards the government in terms of money creation. And you generally see that reflected in the political leaders. Like, for example, Jerome Powell's kind of been dismissive of a CBDC. It's like it's all, they're researching it, they're looking into it, but they're not rushing into it in the way that some other countries are. You also had Neil Kashkari kind of, from the Fed more directly kind of ask like what the point of a CBDC is and kind of talk about how certain contexts you don't really need it. And so I do think that's going to be a trend in the United States and certain other countries. I think the UK will be similar in that regard. Some countries that have more centralized politics might have a better chance of getting a CBDC pushed through. And then there's also a spectrum, right? So a CBDC doesn't on its own mean that it takes away from the banking system. Like, there were recent headlines where UK talked about having a limit on how much you could save in the CBDC. And the reason they would consider something like that is if you're a saver, and you want to hold cash, if you hold cash in a bank, you're subject to loss, especially if you're above in the US, the FDIC limit. Other countries have different limits. If you're above the limit, or you're worried that the limit won't be honored because they actually have to print money if there's a big banking crisis. Like the FDIC only holds like say 1% of the like deposits worth of insurance, right? So if people, for whatever reason, have a non-zero risk assessment of banks. They'd rather hold money directly with the central bank, right? Because they're like, well, I mean, that's a lower risk threshold. So if you're a saver, why wouldn't you pick the central bank? And so you basically, if you don't want to suck all the deposits out of the banking system and into the central bank, you would generally need either lower interest rates or you need limits on how much can be put there per person. And so if a central bank digital currency is primarily just trying to replace cash, right? Which in many cases they are, then they want to have it treated like cash where you don't hoard large amounts of it, that you have small amounts of it, but that larger amounts are stored in banks or government debt or other types of assets. And so to the extent that a CBDC is used to mostly just replace cash but not bank deposits, that is, I think, something that a lot of countries are interested in, even ones with pretty strong bank lobbies, and they would just make sure that there are limits on that. Um, whereas countries that have more command and control style politics are potentially interested in having a more expansive CBDC. From a user perspective, the big risk with central bank digital currencies is that you lose out on privacy, right? So physical cash is a private medium of exchange. It's also something where I mean, it's like no one can shut off your cash, right? It's like they can shut off your credit card, but they can't shut off your cash. Um, and so in a CBDC, it basically gives policymakers more surveillance capabilities, more kind of control capabilities for public spending, corporate spending. Gives them better options to kind of control the types of spending or resource flow that happens. And so from a user perspective, that's one of the key risks there. Whereas from a banking system perspective, I think their main goal is just to limit it so that it doesn't that the CBDC is not more heavily used than physical cash is.
If you enjoy this podcast, you are going to love our free investing newsletter called We Study Markets. We've realized that not everyone has time to listen to a podcast every day or even every week. So we took this same type of content and put it into an easy-to-read newsletter. In just 5 minutes a day, you can stay up to date with what's going on in the financial world and what's happening with your money. And it's completely free. Join over 30,000 other readers now by simply clicking the link here on the pop-up on your screen and then entering your email. It's that simple. Just click the link here in the pop-up on your screen, enter your email, and start knowing what's happening with your money.
So I wanted to talk a bit more about digital currencies. This was related to something Redelio said on CNBC here not too long ago. There's always like this dance between Dalio and Sorkin whenever they speak to each other. I don't know if you ever watch any of that, but it's one of those like Dalio gets asked a question. He really wants to explain and like paint his thesis. Sorkin continues to try to interrupt him and come up with some kind of like headline. Dalio bullish on Bitcoin or whatever it is. He can try to like catch him on, and every time like Dalio takes like 3 steps back and like, oh, but here's the overall framework, and let me dive into these 8 steps one by one, which is just like a terrible format for CNBC. But anyways, but he previously said this on CNBC before he was cut off, I should say. If you want a digital currency, you have to do things differently. I don't think stablecoins are good because you're just getting another fiat currency. What would be best is an inflation-linked coin. So that was the end of the quote. What are your thoughts on Dalio's statement, and how would an inflation-linked coin work in practice?
I think it's one of those things you'd have to talk to him in detail and see what he meant by that, because inflation is, if you say money creation, right? So it's an increase in the money supply. If you use it in modern context, it's consumer price increases, right? And it's due to in part more money entering the system. And there's already official inflation hedges, things like short-term treasury inflation protected securities, things like that. So there are already those in the fiat system. The problem with having any sort of digital currency that's linked to something like that is that you need a price oracle, right? So basically, the network now becomes reliant on some sort of external source of information, right? So if you had some sort of token that, for example, adjusted price based on CPI data, the question is, okay, where is it getting its CPI data? Who's controlling it? who can change the algorithm, how that works, things like that. Something like Bitcoin is designed to be entirely self-referential, right? So basically, there's a network. It's backed up by proof of work. It's not looking out to an external price oracle. It's just Bitcoin, for better or worse, sometimes worse. Bitcoin is what a Bitcoin is. Whereas something like stable coins or other asset-backed tokens, the some sort of central issuer holds collateral, like with stable coins. Let's say for example, they hold treasuries, they might hold, commercial paper or bank deposits, other things like that. They're issuing liabilities that represent claims for those, redeemable claims for those. You can also have gold-backed stable coins. You could have commodity-backed stable coins where you could have the commodity basket in stablecoin format. That's another way of having somewhat of an inflation-linked token of some sort, if people would want it. So there are ways to make these like digital assets that are in some way inflation backed, but they're really not that much different than the kind of inflation hedges we already have. Um, and they're at the end of the day, they're centralized. There's a custodian or a price oracle or something, some sort of governance aspect that is managing that system, and it doesn't really solve anything other that the system doesn't solve now, other than perhaps making it more accessible. One of the kind of the potentials, one of the use cases of stablecoins, for example, is that if you're in Argentina and you're dealing with near hyperinflation, not quite, but almost, might as well be 100% inflation. You could, if you get cash, right, you can hold it physically, which is dangerous. You can also deposit in your banks, but Argentina has a history of saying, "Oh, we have a dollar shortage. We have to go take those dollars and give you pesos in return at the exchange rate that we decided is." So that's a risk. So what a lot of Argentinians do, for example, is they will buy stable coins, and they know it's centralized, or at least if they know what they're buying, they know it's central. It's a centralized product, but the central hub is not in Argentina, right? And so anyone with a smartphone, an internet connection can go buy a stable coin. They can get dollar exposure and just bypass Argentinian banks or physical cash. And that can be true for Lebanon. That can be true for many other Turkey, for many countries that are experiencing high inflation, hyperinflation, that kind of thing. You also see it in places like Nigeria. So that is serving a use case to a lot of people. And similarly, I mean, if you're a middle class Nigerian and you want to buy the S&P 500, it's just, it's hard to do so. If you could tokenize it or something, right? You can make it accessible to more people in the world so that they can access it on a smartphone rather than go through this kind of more legacy, kind of a, kind of complex financial arrangement. But obviously, such approaches have regulatory challenges, as well as some technical challenges. So I think that the more people overthink what a appropriate digital money is, the more likely to be disappointed. Just because anything that you can think of that's complex is ultimately centralized. You're linking back to something, and while it may have certain kind of improvements in the tech rails and who can access it and things like that, it's still not at the end of the day fundamentally different than what we have.
No, and it's. I think you're definitely right that simplicity is key. I was reading this series of articles in The Economist, probably over the past few months, and there were these talks about how Argentina and Brazil would form a union together in like a monetary union. The first time I read it, I was like, this must be some type of April's Fool type thing, and they continue with another article, and apparently it wasn't possible, and they wanted to go back, and then like link it with Argentinian commodities, and it just seemed like a big mess that seemed so unstable. And I know this sort of like if you sort of like knew the answer to this, you would probably have called someone already. But like whenever you have a system like you have in Argentina, I know that's one of the countries we typically take up because of all the things that have happened over the past few decades. Is that really about money? I know it sounds crazy whenever I'm saying that, but is that a money problem? Is it an institution problem? Like IMF often will go and say, well, it's about like building institutions, and is that even possible? I don't know if you even buy the premise for this. I had this intellectual exercise of, can I come up with a good financial system for Argentina? And so far, the answer is definitely no. But now I'm lucky to speak with someone much smarter than me, and which isn't too hard. But what are your thoughts on how to build a system in Argentina?
Well, I'm not smarter, but I'll try to answer your question anyway. Basically, so at the end of the day, institutions and money are tied together. So a country's money is essentially that country's public ledger, and when that ledger is very mismanaged on a structural basis, you're gonna get problems with money. And so you can't really fix the money until you fix the institutions. It's hard to fix the institutions while you have bad money. And so really nothing short of like a wholesale just realignment in terms of domestic politics, people's understanding of money, politicians getting incentives aligned with the longer term could fix it. It's very hard to fix it once you have that kind of spiral in place. Things that essentially have to get bad enough that people just go with a very different approach. Um, and the a challenge with the IMF is that they're kind of based around just perpetuating the current system. I mean, if you look at a lot of these countries, they've had like over a dozen IMF loans, and it's like that quote like insanity is trying the same thing over and over and expecting different results. There's so many countries in the world that have just you look at the list of IMF loans and it's just over and over and over and over and over again. And I think part of that, I mean, part of that is because of those countries' policies, but it's also I think partially from the IMF. Basically, it's like it's like not allowing bankruptcy. It just you never allow the system to kind of reset. You just keep restructuring loans, rolling loans over. And then another thing is that the IMF, in order for countries to take the loans, the IMF gives them certain economic prescriptions. They say, okay, you have to do this, 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 and this. The funny thing is, those are very different than what domestic um, countries do, developed countries do in recessions. So, what does the U.S. do when you have a recession? Well, we print a lot of money. We bail everyone out. We often cut taxes. When emerging markets have recessions, the IMF comes in and says, "Okay, we'll give you a loan, but you have to do austerity. You have to raise taxes. You have to, cut spending, especially on things like healthcare and education. You have to restrict credit to your domestic businesses, but also allow the opening for multinational corporations to come in and buy assets on fire sale prices. Optimize your exports conveniently for developed countries." And so it's kind of this. There have been pretty reasonable criticisms that it's kind of this like neo-colonial policy almost, where you kind of come in and just keep telling them how to restructure their economy. It's clearly not working. You keep doing the same economic prescriptions over and over from an external source. They're very unpopular. They often work with dictators, the IMF. And so I think for these countries that have recurring problems, I think it's both a mismanagement domestically, which is very hard to recover from once you're in that state. And then two, it's just external entities coming out and just keep pushing things that don't work. Right. So I just think it's in some ways I think it's a technology problem. I think we have I think our money technology is still lacking for in one way, but it's also just it's a political problem and it's a geopolitical problem.
Yeah, it's just so complex, and you're like, to your point before, you have this element of moral hazard. So if we mess up everything, IMF will come in again, and they'll probably tell us something that's silly, but at least they'll bail us out. And like, I don't really know how to change that. I don't think anyone does. It's up there together with being the chair of the BOJ or something, like one of those impossible tasks that sounds very prestigious, but probably no one wants really to see if they can solve. Lyn, I wanted to talk to you and sort of like shift gears here a bit and talk a bit more, perhaps philosophical about money, as it hasn't been philosophical enough with everything being covering so far. But as I've gotten older, perhaps a bit, not a lot, but a bit more money, and I also found myself think a lot about how I spent my time and how that works together with building my portfolio and really a quality of life. And I have this thesis really to speak in like CNBC type headlines. I would say optimize for independence is one, but also sleeping well at night is another. And I wanted to explore this thesis a bit more, also knowing that it's inherently filled with pitfalls, right? So sleeping well at night, that's very different from one person to another. One might say, I cannot sleep if I own Bitcoin. And another might say, oh my God, if I did not own Bitcoin, how could I sleep at night? So I guess my question for you is, how do you think about independence and sleeping well at night personally? And how would you encourage our listeners to think about optimizing for those two things? And of course, also you can challenge the entire premise of that question in the first place.
Yeah, so I won't challenge it. I think there's two things that a person has to optimize for that are somewhat conflicting, and that's kind of the balance. One is that someone should be diversified and safe enough that they can sleep at night, right? And that means different things to different people. But basically, they want if there's an asset in your portfolio that's causing you problems and that you keep thinking about, you maybe should own that asset, or learn more about it to check if that's an asset you maybe should get rid of, right? Or maybe you're overexposed to that asset, right? Maybe if you have this if like one gigantic property is like a huge percentage of your net worth, and you're always worrying about the property, maybe you should sell that property and get a smaller property and diversify into other things, for example, right? It depends on what the context is. So one is that, yeah, you have to understand yourself, understand your psychological limits and also the limits of your knowledge, and make sure that you're appropriately diversified and safe, that you can get through periods without making bad decisions. You don't want to sell at the bottom and buy at the top and, kind of lose capital that way, or hold things that are too big a percentage of your portfolio that crash and never recover. Another end of the spectrum, if a person's sleep is based on things that aren't true, that's going to be a problem, right? Because they have to make sure over time that the things that cause them to stay up at night are reasonable things. Um, and so part of it is just education, learning, exploration, to make sure that the risks that they're concerned about are the right risks to be concerned about, or at least a close approximation of the right risks to be concerned about. And one of the challenges in the current era, I mean, like finance and economics and managing assets is, I mean, it's a full-time activity, right? I mean, even professional money managers have a tough time beating the S&P 500. Um, most people, like, if you're a doctor, if you're a lawyer, if you're an engineer, if you're a school teacher, if you're a plumber, if you're, whatever you do for 8 hours a day or more, right? If you also have to come home and just kind of, then you're managing kids, you have a family, you have whatever your life entails, you have hobbies. If you're also expected to just pour tons of hours into multiple different asset classes, you have to know how stocks work. How do, how does money creation work? What's going on with commodities? What's going on with Bitcoin? What's going on with foreign equities? What about real estate? Right? It, it's kind of overwhelming for a lot of people, and they're almost expected to have like a second career. And it's one of those things that, unfortunately, in the macro environment that we are in now, it's somewhat unavoidable. There's no easy answer. um, I do think that it is important, both even just managing your money, but also just making decisions about where you want to live, who you want to vote for, what that kind of thing. It's important to be a very informed person about economics. I think it's something that I wish was more taught in schools. I wish people were more interested in general in it, while acknowledging that not everyone can just put multiple hours a day into the study. So I think it's a combination of, one, you want to have your portfolio simple and diversified enough that you're comfortable with it, but that you also want to over time increase your level of knowledge, so that to make sure that your things you're excited about or that you're concerned about do align as much as possible with reality.
So, Lyn, I wanted to talk a bit about what you said about you can only sleep well at night if what you believe is true. It just opens up for a bunch of other questions, because how do we know what's true? And let me try to explore that a bit more. So, um, I have I guess what you would call a conventional business education and financial education, have a degree in that, and we were taught already I think on the undergraduate, but definitely whenever the graduate, we had like these stock investing courses where you learn a lot of things but not anything about stock investing, ironically. And one of the things you learned, at least we learned, was that Warren Buffett was lucky. And Buffett was the luckiest person, which is why he had the best returns. And because it could be explained with the efficient market hypothesis. And of course, like my old professor, he always had this joke like, oh, but look at Buffett, but I drive a Kia. Perhaps I'm not right, but we did have a section about Warren Buffett being lucky in the textbook. I know it sounds crazy, but we did. And so, I coming into the stock market myself and having another job in the financial industry, you sort of like learn that markets are not efficient, and you start to think differently about investing. Then a few years ago, I read this book about the modern monetary system, or the MMT. It was Stephanie Kelton's book, The Deficit Myth, and I read about it first, and I felt it was ridiculous. But I also kind of felt, well, it was also kind of ridiculous going in. Like, I learned in business school, like Warren Buffett, it was just pure luck. So why wouldn't I try to challenge myself? And I started reading the book, and I found myself being so, I wouldn't say angry is the right word, but I kind of feel it was such a waste of my time that I had to stop midway, which I usually don't do with books, because I felt it was just crazy. But it also sort of like goes to the point about, what if it's not? And I'm not so much talking about MMT as I'm saying this, but like this whole notion about what you have believed in so far just isn't true. So how do you think about that whenever you learn about finance, given that you also want to sleep well at night?
I think one thing I keep in mind is that the era we live in, like it's like a fish in water, right? Whatever you live in just seems normal. One of the challenges that the era we live in is conceptually just very unique in terms of monetary history. Basically, it's the only time in the world where the entire world was on a fiat standard, and it's only in our parents' lifetimes, right? It's like it's not as long lasting and durable as we think it is, or at least historically. And the future can be there's a broad range of outcomes for what the future could look like in terms of how our money works. And so I think the first step is just to always have an open mind. Money's constantly transforming, especially in the past 150 years. And there's no reason to assume that this current, period is like the end state, that we've fixed money. I think our prior discussion around why are there dozens of developing countries and the IMF doing the same thing over and over and breaking constantly? Maybe the system's not the highest possible peak of how the global financial system is going to be structured, for the foreseeable future, right? Um, so I do think it's important to keep an open mind about how money works. I think that's number one, and just kind of always challenge your assumptions, and always like, what are the most foundational axioms that you're assuming that just might not be true, or might work differently than you think. When it comes to MMT, I find it interesting because I generally disagree with most of what they say, but there's a couple observations they make that are not wrong, right? It's mostly that they describe how the system works, that in many cases they're not necessarily wrong. It's then what they say you should do about it is where I would very much disagree. Like the idea that the government deficit is a surplus for the private sector is often a term you'll hear in MMT, and it does become relevant in certain contexts, right? But because I think a lot of MMT people are incorrect about a lot of things, they get disregarded. Whereas, like in many schools of thought, even if you almost entirely disagree with that school of thought, there's usually a couple things in that school that are useful to incorporate into your broader knowledge set. And so I think even things you disagree with are kind of worth exploring up to a point. Um, I like to phrase it as like you should be able to steel man any kind of argument, right? That's relevant to things you care about, right? Meaning that you should be able to state the case for that school of thought in the way that makes it the strongest possible description of that school of thought, and then be able to dismantle it, right? Assuming you disagree with it. And so I think that applies to MMT or other things as well. That I basically think it's important. One, always challenge your own assumptions, and two, make sure you fully understand opposing schools of thought rather than just dismiss them.
Yeah, and I think that's a great idea. And for the record, I did ask Stephanie Kelton to call on the show with no luck, but I it would be curious to hear how. And I think it's true. And I think it's important that you keep an open mind. Like to your point before, like there's this like I was taught in like the Keynesian way of doing things, which is generally how textbooks across the developed world are being taught. And then you have like more than one school of thought that really disagrees with everything. But I would also argue that most people who are in that camp have never read a book from Keynes at all. They just think Keynes equals money printing, full stop, which is the very opposite of what it's actually about. And this is not me trying to be like, oh my God, Keynes is the best thing in the world. This is my point of saying this is a different world, and what you see now is also not Keynesianism. It's what economists would call new Keynesianism. But that's sort of like discussion for a different day, I guess, because I wanted to rope myself back in, and I wanted to continue talking a bit more about money and happiness, for the lack of better words. And there's this wonderful book here. It's called The Art of the Good Life, that's written by Rolf Dobelli. And in the afterword of that book, he talks about how you can't say what a good life is, but you can easily say what a good life is not. Just kind of felt that was an interesting observation. It really makes me think about how Munger also talks about you have to invert, always invert, sort of like thinking about it from that angle. And I wanted to bridge this to our discussion about creating the right portfolio. So perhaps instead of talking about the optimal portfolio and thinking about how much equity we're gonna need, how much long duration bonds we're gonna need, but like, I guess I wanted to rephrase that question as you, Lyn. Instead of talking about the optimal portfolio, can you tell me about what is the optimal portfolio not?
So I think the optimal portfolio that's not, or kind of the description of a bad portfolio, would be one that is too concentrated, especially in something that you don't fully understand, especially something that is extremely volatile or that you're excited about. If you're super excited about your portfolio, if you think about it all the time, you're probably taking too much risk. Really, you're probably not having a sober analysis of the risks, and you're over enthused, and you're open to more volatility and downside risk than you're probably aware of. Um, so I see people that, for example, they'll have, say, a similar macroeconomic outlook as me about, they expect the 2020s on average to have higher inflation, X, Y, Z. And then but then their portfolio is like, a huge amount of like junior gold and silver mining stocks, and then crypto, and then like, something else. And it's like that, basically it's an extremely like a volatile portfolio, very gamified, very explosive upside, and then can collapse. It's also an area where the median entity does not do well over the long term, right? So the median gold miner is like a terrible long-term investment over history, and the median crypto just doesn't do anything, right? I mean, there's 20,000 cryptos. We keep making more. They're not really solving, most of them not solving unique problems. Most of them don't have like a second or third cycle of rising growth. Most of them have these like pump and dumps, and then they're dead, right? So if someone's like, entirely in like mining stocks, like junior mining stocks and crypto, that's probably not conducive to long-term wealth accumulation, for example. So I think that's one of the examples I often see, is just being overly focused on a narrow set of things that are also not necessarily sound investments. That's kind of a good description of an awful portfolio. On the other side, and this goes back to actually like making sure that the things that allow you to sleep at night are not entirely wrong. Right? So a lot of people, they don't want any volatility, and so like they're entirely in like cash and government bonds, or almost entirely. And the risk there is that you're entirely attached to that public ledger, right? You're entirely attached to the competence of institutions. You hold non-real assets, that can be, their supply can be changed. They can underperform inflation for years and years and years. They can have big stepwise devaluations. And so, for example, if people in the 1940s were afraid of war, and therefore they held cash and government bonds, they got sharply devalued. Um, Same thing if you went into COVID and you were afraid of owning any assets and you held cash and government bonds, well, you got sharply devalued, right? Um, and so there is also something we said about being overly cautious, not understanding any assets, not wanting to own any assets, and just owning the underlying currency, or currency derivatives, because that's also I think a key long-term risk. You risk failing to meet your retirement goals, and you're basically you're kind of like the sucker at the table that keeps getting drained like a melting ice cube to pay for other things, right? And so your fear of volatility is kind of being used against you, right? So I think kind of an example of what a good portfolio is not is one that tends towards extremes, one that is very casino-like, or one that is so risk averse that it is pretty much just designed to fail to accrue purchasing power.
I think it's also it's interesting to think about how we all the product of the time and what we experienced. I from my time as a college professor, I was for obvious reasons speaking with a lot of young people, and a lot of them were interested in investing. So we talked a lot about investing, and they told me how diversified they were because they had all these different cryptos. Like they only own cryptos, but they talked to me about how diversified they were because they had so many different cryptos. And then I came, visit my parents, and they paid off their house, and they have the rest of the wealth in cash, and they feel like they're safe. And it's so I can stand there in the middle and be like, oh my God, why would anyone only own cryptos? Why would anyone pay out their mortgage and just have the rest in cash? And look at my fantastic portfolio. And that sort of like goes back to also what I said before about MMT and feeling it's wrong, which it may or may not be, who knows? But we all have these preconceived notions of what have we experienced. We might not think about what we have experienced, but we all have our own truth based on our own experiences. So yeah, I guess that's my sort of like humble approach to go into or rounding off this interview.
Yeah, I think it's the challenge because I think a diversified portfolio is the best risk adjusted return you're going to get. The downside is that it either requires knowing a lot about different assets, or it requires kind of blindly trusting the process, with ETFs and things like that, right? So when in doubt, diversify. But I think that the match there is to kind of increase your not you, but for in general as an investor, as a person going through life, increase your level of kind of financial education as much as possible, because it's one of the things that's just universally important. We have to know about how different assets work, even though we shouldn't, in a better macro environment, we shouldn't be expected to. We shouldn't have to know about different investments the way that we do these days, but especially in this kind of current era, which I think is a challenging transitional period. It is important, I think, to know about financial markets, about economics, and about kind of how to preserve and grow your purchasing power. Because I think this is an important life skill that we all have to focus on and avoid extremes. Make sure you're comfortable, but then make sure your threshold for what your knowledge based comfort level is always going up over time.
I really like that you say that, and to talk a bit about some of our own blind spots, perhaps. We also do this for a living. I don't know if I hope that makes us smart. Who knows? But it's sort of like goes back to also what I mentioned before. Some of my friends who have been really successful with real estate, and now they feel like now they really need to diversify. So now they want U.S. stocks, and I go like, no, that's not diversified enough because you need all these other asset classes. Like, but I have 2 asset classes. That's enough. U.S. real estate, U.S. stocks. That's way more diversified than it was even before. And I'm like, yes. So I think it's just so complicated, and so that's really why I wanted to speak with you, Lyn, because you're one of the smartest people I know, and I just want to what Seamus gonna say between this recording and whenever it goes out, we have scheduled Dalio. I want to say that the interview has already been done and has been published. So I just want to put Lyn up. I hope you don't feel embarrassed, but I want to put you in like, I think you're super, super smart. So that's why I want to hear about you personally, and not just I wouldn't say just, but like the Fed went broke, but also like how do you see money personally, and how you manage your own money and think about money, as I'm sure a lot of listeners are around our age too. I guess I want to use that as a transition into talking about how you spend your money to optimize for happiness. Again, I'd say before I do, please challenge the premise if you want to, that you do use money as a tool for happiness, or perhaps that's not the primary use. Um, my premise is that people use money to optimize for happiness. They might do it the wrong way, they might do it for the wrong reasons, but that's the underlying premise of having money. So I'm sort of like a bit more of a philosophical discussion, but I want to throw it back over to you, Len.
So I actually I think we can take the prior discussion and combine it into that, because I think the way that I approach how to spend money is to invert, right? So it's less about spending money to be happy. It's about spending money to solve problems or things like fix things that make me unhappy. If there are things that are fixed by money, which some things are, right? And so I mean, there's actually one thing you can do is look at studies, right? So what are things that like reliably make people miserable, like really long commutes, for example, a really bad mattress. There's like certain things that like reliably make people unhappy. So one is using money to solve those like reliably unhappy things. Either being able to get a different job or being able to get a different home, right? To either not have a commute or have a good commute, for example. Being able to, there's certain things that just give you discomfort. To solve those, like for example, I don't travel well. Some people just travel well. I have trouble sleeping on airplanes. I have trouble just sitting up for like if I'm going international and like sitting up in a cramped seat for like 12 hours. So for example, splurging on like a business class sometimes is a way to I get there and I don't feel like I regretted coming here, right? It's like it makes the trip better. Um, on the other hand, like I avoid I don't spend money on like cars. I don't spend money on designer clothes. I don't spend money on just frivolous things that don't really bring me happiness, but that in some context might bring other people happiness. Um, and so for it's I mainly use it to solve pain points. And then I guess even zooming out more philosophically, one of my pain points is the idea of uncertainty, right? So I might have mentioned on your podcast, I've certainly mentioned on other podcasts, my writing. When I was a kid, I was homeless for a period of time. And then after that, it was like a trailer park. The childhood was always like just always kind of a financial uncertainty. And so I think that kind of, if anything, it kind of overcorrected my mentality towards saving, investing, having very high margins of safety for everything. And so for me, one of the things I do with money is save it, invest it, build larger and larger kind of income streams, build larger and larger savings reserves up to a point, so that I generally reduce the uncertainty around the future. Right. So that's another pain point that I solve in addition to those more just like direct pain points. So I think if someone realizes that, money doesn't create happiness, money can just fix a couple things that can get in the way of happiness, whether it's a long commute or whether it's, not having enough time with their family, or whether it's, just you hate flying, for example, whatever the case may be. If there's certain annoying things, money can solve those annoying things. But happiness doesn't come from money. Happiness comes from your outlook on life, your relationships with other people, being passionate about how you spend your time, what work you do or what hobbies you do. It comes from health, staying in shape, getting sun, getting exercise. Um, that's where happiness comes from, and money is just kind of a tool to, I think, eliminate or reduce problems.
I think that's well said, and it reminds me of that story where a rich man died, and it was asked how much did he leave, and the answer was all of it. Um, Lynn, it's always wonderful speaking with you, and I already look forward to hopefully being able to invite you on again. Um, Before we let you go, I wanted to give you an opportunity to tell the audience where they can learn more about you, your research, and your wonderful blog.
Sure, I'm at lynalden.com, so people can check it out there. I have public articles. I have a free newsletter people can sign up to. It comes out every 6 weeks on average. And then I also have a low-cost research service for people that want more frequent updates every 2 weeks approximately. So we cover macroeconomics, specific investment ideas, and try to just tie a lot of these themes together where, I have these kind of like long-term theses, like, what do I expect the decade to look like directionally? But then, just things change over time. We have periods where we have counter trends to those theses, and so it's kind of like these other types of updates, kind of just analyze what's happening. What is the process? What is going as expected? What is not going as expected? What is the expected timelines for some of these things? And so I just basically think this is a challenging decade. And going back to what makes us happy, I get a lot of enjoyment out of like being a detective, essentially, a financial detective, just kind of researching, trying to put complex things together in a way that is accessible to even just myself, just kind of figuring out things myself and hopefully share some things along the way.
Wonderful. And I would just highly encourage everyone to go into to lynalden.com. The blog is absolutely amazing. I read it rigorously. So thank you again, Lyn, so much for coming here on the show. Yeah, as always, it's a privilege having the chance to speak with you.
Thanks for having me. Always happy to be here.
Thank you for tuning in to today's episode of We Study Billionaires. If you enjoyed this episode, we would really appreciate it if you subscribe to our podcast feed using the link here on the screen. This will really help support the show so we can continue to provide this great content to you for free. We appreciate you being a listener and hope to see you again next time.
When they did that financial repression playbook of, hold rates, basically let inflation run hot compared to interest rates, eventually people want out. There's that IMF paper by Carmen Reinhardt. I think she phrased it like you need a captive audience, right? If you're going to inflate the debt away, you got to keep people in the debt. And if your money is going to lose value, how do you keep people in the money?